Welcome back to Finance in Focus, designed for educational and informational purposes only, not investment advice. Today I want to take a step back and talk about what we're seeing across the broader economic landscape, interest rates, the Federal Reserve, housing, and market behavior, and why so much attention right now is focused not just on what's happening today, but on what could change over the next year or two. This isn't about predictions, market timing, or telling anyone what they should or should not do. It's about understanding the environment we're operating in and why uncertainty feels elevated, even though markets have performed well. As of now, the Federal Reserve has chosen to hold interest rates steady. That decision isn't particularly surprising. Inflation has moderated from its highs, but not enough for the Fed to feel comfortable that cutting rates aggressively wouldn't create additional issues down the road. What's more interesting is the bigger picture surrounding monetary policy. Jerome Powell's term as Federal Reserve Chair ends in May of 2026, and while the Fed is designed to operate independently, leadership transitions have historically coincided with shifts in tone, priorities, and long-term policy direction. Markets don't wait for those changes to officially happen. They tend to anticipate them well in advance, and that anticipation can alone influence investor behavior, asset prices, and overall sentiment. That's part of why it feels like we're in a holding pattern right now. A period where people are watching closely but not necessarily acting decisively. When you look at the stock market objectively, recent performance has been strong. Earnings growth, technological innovation, and continued spending by higher income households have supported prices. At the same time, expectations looking forward have become increasingly optimistic. Many forecasts still assume positive returns ahead. Historically, when downside scenarios are largely absent from expectations, markets can become more sensitive to unexpected events. That doesn't mean a downturn is inevitable, it simply means expectations matter more than people often realize. A large part of the current optimism can be traced back to a few key themes. One is continued investment in artificial intelligence and technology, which has driven capital spending and productivity expectations. Another is the belief that interest rates will eventually come down, even if the timing remains uncertain. And a third is the resilience of consumer spending among households whose assets have increased in value. These factors can coexist with elevated valuations for longer than many people expect. History shows that markets don't reverse simply because prices appear higher, they tend to reverse when something structural changes. At the same time, these are pressures beneath the surface. Consumer spending has become more uneven with a meaningful portion of economic activity supported by asset values rather than wage growth. The US dollar has weakened relative to other currencies. Government deficits remain elevated, and trades and geopolitical risks continue to appear periodically. None of these factors operate in isolation, and none of them guarantee a specific outcome, but taken together, they contribute to a sense of fragility that doesn't always show up in a headline market performance. Housing is a good example of how this uncertainty shows up in real life. Sales volume have slowed, inventory remains limited, and affordability continues to be a challenge. Buyers are hesitant at current mortgage rates and sellers are reluctant at lower prices. The result is a stalemate. There have been discussions around policy tools aimed at improving housing affordability, but the mortgage market is extremely large. Smaller interventions tend to have limited or temporary effects. For now, housing activity remains muted, and outcomes depend largely on interest rates and broader economic conditions. One of the most important lessons from history is that markets can remain elevated longer than people expect, even after concerns are raised. In the late 1990s, warnings about excessive optimism did not immediately lead to declines. Markets continued higher for years before conditions ultimately changed. That history doesn't suggest complacency, it suggests humility. Markets rarely turn simply because they appear expensive. They tend to turn when something underlying the system changes. At a high level, the environment ahead appears to be defined by a few broad possibilities. If interest rates remain higher for longer, borrowing stays expensive. Housing activity remains constrained, and markets may experience continued volatility. If rates decline more aggressively in the future, asset prices across multiple areas could continue to rise. Both outcomes are plausible. Neither is guaranteed. The key takeaway isn't about choosing one outcome over the other, it's about recognizing the uncertainty itself is a risk factor. Long-term outcomes are rarely determined by perfectly predicting the future. More often, they're shaped by behavior during periods of uncertainty. Periods like this tend to reward patience, discipline, and understanding of how different forces interact over time. As conditions evolve, staying informed and grounded becomes more important than reacting to short-term headlines. I hope you found this Finance in Focus discussion helpful. If you did, make sure to like and subscribe to stay up to date with future content. Thanks for watching.